Now, U.S. markets have continued to trend lower as trade war fears were renewed. I forgot to ask you about the trade war's potential and its impact on your business. Now, that follows, of course, the resignation of Trump's economic advisor, Gary Cohn. Back at home, fourth quarter GDP rose by 3.1%, bringing growth for 2017 to 1.3%. Joining us now is Harry Plumstead. He's an economist and investment strategist at Avior Capital Markets. Harry, thanks for the time. So, GDP 3.1%, agriculture powering that. I think the number that I saw was 37.5% up. Was that within your numbers, or were you amongst the surprised?
The print surprised us to the upside, but it does fall broadly within our expectations for where GDP is heading. So I think we're probably at the moment the most bullish on the street on SA GDP. We're looking for 1.8% growth this year, but 3% growth in 2019. Just as a function of, a number of factors. If you look historically, where you have an environment where global macro is strong, a local cyclical recovery is taking hold and strengthening, and you have the added catalyst of some perceived change in direction in the political arena, you generally don't get what I think is being reflected by quite timid increases in growth in the forecasts that we're seeing.
Yeah.
It's more generally a regime shift higher in growth, and that would take us to potentially a two-handle quite quickly.
Right.
And then it has subsequent effects of increasing earnings expectations for SA encounters or companies locally that generate RAND revenues.
How much would you ascribe the higher numbers that you are forecasting for 2018 and 2019 to Cyril coming in on the scene and what appears to be a change in terms of the government's approach to business?
Difficult to attribute a portion of it. So our view has been that this is actually a normal cycle. That data actually was starting to turn quite early. Say August, September last year, we saw data improving, and the cyclical recovery really was sort of banging on the door, and you just maybe needed something extra to break the hinges. So maybe that was the SA NEC conference at the end of the year. It's difficult to say, but we certainly think that at least 80% of the economy, if you're looking at it from the expenditure side of the equation, is set for a very, very good run in the next 2 years. So that's household final consumption expenditure making up about 60% of GDP. We think the consumer will benefit from some of these slow-moving processes that for a long time have actually held back growth.
Yes.
Things like elevated inflation, borrowing rates were probably too high for where the economy was running. So those kind of things moving in a position where they're probably net contributors to growth over the next 2 years. And then another 20% of GDP in private investment expenditure. We've seen a tangible change in expectations from our corporate clients in conversations with them, now sitting on cash and actually wanting to spend it in South Africa, not abroad. So big changes.
Having said that, there are headwinds, and I think we can tick off a number of them. We spoke about one earlier, the potential for trade war between the US and I think we can say the rest of the world. And then there's, of course, the VAT increase that came through in that budget by the finance minister. And added to that, I don't know if it's a big headwind, but it's something that I keep raising because I think it needs to be debated. The expropriation of land without compensation potentially becoming law in South Africa. When you look at those things, how much do you think they would detract from growth?
So big tail risk would be the possibility of a trade war globally, sure. Through January, the market was not pricing any risk of this. In fact, it was pricing very little risk in general. Yes, exactly. I think we were here on about the 26th, or it was late January, saying that we needed an upward correction in implied volatility in global markets and downward correction valuations. I think that was the story of February and the first week of March. That's now behind us. The markets are digesting this potential for a trade war. We don't think it's going to fully ramp up into the proper tail risk scenario where it would send a large negative shock through and obviously negative impact global growth. But sure, the markets are going to be slightly more volatile over the near term to try and digest that. On the local side, yes, so that broadly a negative fiscal impulse for the economy. We just think that's outweighed, and our model suggests that will be outweighed by the positive contributions made by lower inflation. I mean, inflation's come down now looking at component metrics of food inflation from 12% in December 2016 down to, say, under 5% now, allowing the SARB to be looser, lower borrowing costs, a strong rand, higher confidence. So yes, that a headwind again on the local front.
But neutral. And land expropriation potentially?
So we're looking there, we're cautious to make big claims on, on how serious this is. A lot of our foreign clients are asking us very tough questions on that. It is a concern that the narrative has taken that direction. At the moment, we're saying, look, it's probably an effort to appease the left before an election year. It might go the same way as, the prior rhetoric on nationalisation of mines. And so it's nothing to derail the whole buy SA Inc., buy SA Beta thesis that we're proposing.
Sounds like you trust Cyril.
No comment on that.
Harry Plumstead is Economist and Investment Strategist at Avior Capital Markets.